But
borrow
is
from the
this
Treasury and
omnibus
guarantee.
legislation that they're kicking around, ma'am, going to include backup reserves for you, or is that just understood?
We already have backup reserves. That's what's not understood.
So when people hear this $43 billion figure, they thought, man,
we
you're
have
running out of money
reserves.
faster than we are.
We have a lot of backup reserves. For both working capital and to cover losses. Yes, under any scenario, believe me, the Treasury would be there. If we have to borrow money, we can borrow as much as we need to make sure our guarantee. People should not worry about that.
I'm looking at that. She has not aged a day. I have gotten far worse toupees. Welcome back, everybody. 10 years ago, in the middle of this meltdown, there it was, the FDIC chair, Sheila Bair, throughout the crisis, warning about how we get out of it and not compounding our problems with debt and everything else. Long story short, we did get out of that crisis, but she's back here to say, history might not exactly repeat itself, but it does have a nasty habit of rhyming. She addressed this a couple of years back in a great book, Bull by the Horns, Fighting to Save Main Street from Wall Street and Wall Street from Itself. One of my favorite reads of that whole era. Sheila Bair, good to see you.
Thanks for having me. Nice to see you.
Could it happen again?
Well, I can't say that it wouldn't happen again. I think there are a lot of warning signs. We had a debt-driven crisis in 2008, and through low monetary policy, we basically used debt to try to engineer a recovery.
You took out a big old home equity
loan.
Right?
So now we're, government debt, corporate debt, non-mortgage consumer debt. It's all at historic highs, and it's not sustainable. And I do worry that the economic growth is being driven too much by unsustainable debt-driven consumer spending and corporate
Do you
spending.
see any bubbles anywhere? Now, a lot of people were saying, ahead of the last crisis, real estate was looking like a five-car Monte. I mean, people were buying property sight unseen before buildings were even up and then selling them to someone else who was equally eager to do. Any of that going on?
Well, no, I don't think things that egregious are going on. But we do, again, because of this extremely protracted period of low interest rates, asset valuations, or in my view, and I think a lot of other people's view, are quite inflated. Financial assets in particular, stocks and bonds. That's going to
So you think this is very rich? Yeah.
I do, and real estate, commercial real estate.
Said not as rich as you think, given multiples.
There are people of goodwill disagree on that, but I do think, as a general rule, because this protracted period of near zero interest rates, assets across the board are overvalued, and that does create problems for stability, especially, the capital markets may be a little bit more resilient, but banks do a lot of collateralized lending. The collateral values fall, as they did with mortgages in 2008.
So if one
and
of
you
those
could have a
big
problem with
banks
the banking system.
were pushed into a corner, it says that now we don't rescue them. I cannot imagine we wouldn't.
Well, I hope we don't. There are new powers under Dodd-Frank. They gave the FDIC the power to resolve, basically put into a bankruptcy, a government-run bankruptcy, large financial institutions. We didn't have that during the crisis. We only had it for insured banks. And so that's positive. There are limits on the Fed's ability to provide one-off support, as they did with Citigroup and others. That's been taken away. They can still provide broad-based support. If there's a truly system-wide problem, they can provide, general access to their lending facilities. But if you have individually poorly managed institutions, they are now supposed to go into Title II, which is a very harsh process.
Well, let me ask you about that, because I always think that what compounded everything, I know banks, to your point, are better capitalized now. They have more emergency funds on hand just in case everything goes kablooey. That's a financial term. But I think in a market downdraft, all bets are off. And I remember 10 years ago this week, a lot of those stocks were cascading and losing their value. And that was the means, that was the currency. And it didn't matter how much capital they had on hand. It couldn't reflect what they were losing in the market.
Yeah.
So how do you deal with that?
Well, that's true. I mean, markets can react very quickly. And what we saw in 2008 is that because large financial institutions were borrowing a lot themselves and borrowing very short term, they had all these mortgage exposures, a lot of them very esoteric, structured products. Who the heck knew what they were, what their losses?
Names, right?
I know, and they were very thinly capitalized.
You were one of the first to say these packages and everything else.
Yeah, I know, Joyce.
There were words for it, but I can't repeat them. But they always come up with these creative innovations.
They do. Well, the lack of transparency hurts accountability. So how well capitalized are they? Is it 5%? Is it 10%? Or is it negative?
Well,
I mean, layman was
today getting packaged securities, the details of which they still don't know. I always think it's a different flavor, different decade.
Well, it is, and it's frustrating because I do think regulators and people in Congress, those who are involved in making financial regulatory policy, need to understand that Wall Street is in the business of making money. That's what they do. That interest is not aligned with the public interest, particularly when they have deposit insurance, they have access to Fed lending, they have these potential bailout tools that could be used and available to them. And so policy
So when Bank of America
and
Merrill Lynch are joined at the hip,
right.
That worries you.
Yeah. Yeah, well, yeah. I mean, I think that the bigger the institution, the greater likelihood that they can kind of, which as we saw in 2008, kind of blackmail the government. And, though I think in 2008 we could have imposed a lot of accountability and losses on shareholders and unsecured bondholders that we didn't do. We just didn't have the political will to do. So I'm hoping under the new Dodd-Frank framework that will happen again, because that's really where we need the market discipline.
I just find a lot of these guys so hypocritical. So I said it 10 years ago, I'm saying it now, that they will point their finger about, you don't bail this group out, don't help this group out. It's sort of like me telling you to eat a salad. People would look at me once and just say, Neil, really? And yet these are the same guys doing that, and they got the biggest bailouts of all.
Yeah.
Now, I'm not here to question 10 years after whether it was a wise thing or bad thing. It was a precedent-setting thing to a group that really had beyond arrogance here.
Well, it was, and it's a precedent we don't want to repeat, and that's why I get nervous about current calls to expand bailout authority and prepared. We've got to have bailout tools if it happens again. I don't want it to happen again, and I want the priority to be to preventing it from happening again. And that, first and foremost, means much stronger capital requirements. Make sure the equity
even
holders...
stronger than now?
Yes, I would make them stronger, absolutely. But as you know, in Washington, they're under assault now. There are a lot of efforts to reduce those capital
Geithner, of all
rules.
people, is leading that charge.
Well, he certainly wants more bailout authority. Yes, he's been very vocal about that. But Congress has passed a law reducing capital for some of the largest banks. It is incredible. Short memories, very short memories.
Sheila Bair, thank you very, very much. She really was one of the heroes of a decade ago. Got very little credit because she was calm and reasoned and thoughtful. But as I always said, she ticked off both sides, which instantly made her a hero.